Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about PI Industries, which is an interesting company that is coming at very attractive levels. So let's understand about the business and let's see what needs to be done. Let's get started. First of all, a disclaimer that this is not a stock recommendation and people taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I discuss about PI industry, here's a small request that kindly support me on Patreon, and once you do that, you'll get a lot of perks on Patreon and will help me grow the channel here on YouTube. You'll be able to get from $2 to $25, whichever tier you choose, from answering all your queries at a $2 level to helping you with your portfolio, etc. at $25, and you can choose different tiers in order to get different benefits. So just go through it. I put up stock ideas and stock analysis at a greater detail than what I do here on Patreon, and those members get a privilege of different types of exclusive videos as well as articles on a weekly basis at Patreon. So kindly visit the site and you'll find a lot of stuff there. Now about PI Industry. This was established in 1946 and they manufacture agri inputs comprising of crop protection, chemicals and plant growth. So they are basically in that similar domain as other crop protection companies like Sharda Cropchem, UPL, United Phosphorus, which also makes crop protection products, etc. But PI has their own brand which are doing well. So they are one of the best companies and oldest companies in this segment. They have over 40 products with brand names in various domains for crop protection, and it is being sold across India and globally. So it is a very prominent national player, and it has been in the market for years. The market cap of the company is around 18-20,000 crore at the moment. If you look at the financials of the company, then the sales were up 20% even in difficult environment for the December quarter compared to last year, and the profit was up around 12%. It is completely debt-free company, so there was a cause for higher expenses which led to lower profit growth. Otherwise, the profit growth would have been 18-20%. But due to higher raw material cost, there is higher expenses that is there. There is very high institutional and promoter holding, and only 9% free float is there. Free float means that the amount of shares that are with the retail investors that are virtually traded on a daily or a weekly basis. So high institution and promoter holding, which keep the stocks with themselves, is around 90-91%. Return on equity is robust, around 23%, higher than the industry average, and the operating profit margin is again higher at around 21%. If you look at the performance of the stock has went up 2.5 times in the last 5 years. So it has gone up significantly from the levels that it was trading 4 or 5 years back, and it has done that quietly. So it does the quiet moves of 1.5-2% every couple of days, and so on and so forth. And whenever the markets fall, the stock doesn't fall a lot. This is because there is low liquidity, and as I said, higher you can say 90% of the stocks are with high net worth individuals, FII DIIs, and they don't trade into the stock. They buy it for 5, 6, 8 year time frame unless something bad happens with the numbers. It has fallen 35% in the last 1 month, 1.5 months, when it made the low in end of March. So in that regard, it is coming at a very good discount, because normally it trades around its all-time high, around its 52-week high, so just 10-15% lower, but here it fell something like 35%, and of course it has recovered from those levels, but still it is lower in trajectory. Strong operating numbers, as I explained in the performance, and the dividend payout is also good for the company, and they give out decent dividend compared to what the profits that they make. So why I believe it is a buy on decline, and it is a market leader in its space with some of the brands pretty marquee in the domain. A number of top brands, as I said, selling across India, and it will outperform as rural economy recovers. So before, as I have explained in many of the videos of the rural stocks, that in February when the tractor numbers came out, Escorts came out with a fabulous tractor numbers for January, and that showed that things are very much at the mend in the agricultural space, in the rural space, and we could see very good growth going forward. But then we had this issue that we are having at the moment, and everything collapsed. But one needs to understand that once everything normalizes, probably in 3 6 months, 9 months time, these will be the stocks that will again come back in focus, and they will probably jump up much higher and go to new highs, and have more probability of going to new highs compared to other companies. And so the recovery in tractors, as I said, was a positive signal in January. The valuations currently is at around 38-40 times EPS, which is reasonable because it trades at around 50-60 times earnings. So it is at around, still it is around at a 20% discount. May have run up in the last 1 week, 10 days, but when I was making this presentation, etc., the valuations were even cheaper. So one can look at the company on a decline. If you look at the technicals of the company, then you need to so actually what needs to be done is you need to buy on major decline. So if you look at the technicals of the company, there is strong support between the 950 to 1030 levels. So one can look at that as a stop loss. The 200 daily moving average is around 1300. So once it moves above it, it will perform even better. From February till March and early April, the stock has fallen vertically, and there could be some trepidation, and the stock may come back pretty vehemently, but then there could be even more correction. So if the market corrects even 10-15% from here, 10% from here, the stock will correct 6-7%. So wait for major falls to accumulate into the stock, or when it goes past 1300, you can buy big into the stock, because that would be a precursor to another huge up move in the stock. The long term stop loss can be placed around 900 850 levels, and that is for somebody buying for a 5-7 year view. Then he can gradually buy into the stock on declines and keep a stop at 850. It can be a multi-bagger over say 6 to 7 years for sure. It will be a multi-bagger. A good 18-20% return year on year is safely possible in the stock. So what needs to be done? In my opinion, you can buy this company on major declines and keep track of the numbers. I believe the numbers would be not that great for the June quarter, and maybe may not stabilize till September, but post that we could see a real surge in the numbers. And what everybody is expecting is that the numbers could improve drastically for these companies, which have done reasonably well when the circumstances were normal. So these companies could come back very fast once things again get back to normalcy, and things go right. So probably 6 to 9 months time, I'm expecting FY say 22 could be very big for these companies like PI Industries, Pidilite, Asian Paints, Escorts, etc. So one needs to have an idea, and do not go ahead and buy big in one go. Just try to do an SIP into these stocks which I talk about that you need to buy into, and you'll get a very good average price. So it can easily give 2-3x return from here, and kindly have a 5% exposure in the stock. So this was a video on PI Industries. Please like and subscribe on channel, hit the bell icon. Thanks a lot for watching.